Good morning, friends. I'm Dr. Elizabeth, Assistant Professor and Head, Department of Commerce, Nirmala College for Women. Today, I'm planning to discuss about an interesting topic, working capital, which would be quite useful to everyone. Today's discussion will go on under these three heads: meaning, definition, and concepts of working capital, importance of working capital, and factors influencing working capital. Capital required for a business can be classified into two categories. One is fixed capital and another one is working capital. Every business needs funds for two purposes. One is for its establishment and another one is to carry out its day-to-day operations. Long-term funds are required to create production facilities through purchase of fixed assets such as plant and machinery, land and building, furniture, etc. Investment in these assets represent that part of firm's capital which is blocked on a permanent or fixed basis, which is called as fixed capital. Funds are also required for short-term purposes. Take for example, to procure raw material for payment of wages and other day-to-day expenses. So the funds required to invest in current assets is called as working capital. In simple words, amount required to meet day-to-day expenses is called as working capital, and amount to be invested in fixed assets is called as fixed capital. Coming to definition of working capital, it is the amount of funds necessary to cover the cost of operating the enterprise, according to Shubin. Here, the point to be noted is, it is the amount of fund necessary to cover the cost of operating the enterprise and not for establishing the enterprise. There are two concepts of working capital. One is balance sheet concept, another one is operating cycle concept. To start with the balance sheet concept, there are two types. One is gross working capital and number two, net working capital. Gross working capital is the total of all current assets like a cash in hand, cash at bank, sundry debtors, bills receivable, short-term investments, prepaid expenses, short-term loans and advances, advanced. All these are current assets. So the simple total of all current assets will give you gross working capital. And the second concept under balance sheet concept is net working capital. Net working capital is nothing but total of current assets minus current liabilities. In other words, excess of current assets over current liabilities is called as net working capital. The next concept of working capital is operating cycle concept. You know, any cycle keeps going, keeps moving. It's not possible for you to say that it starts at this point and ends at this point. It keeps going. In the same way, in working capital cycle also, for a manufacturing concern, raw material is procured with the help of cash. So here we are starting with cash that is used to procure raw materials, which is converted into finished goods. But before reaching the point of finished goods, this raw material has to go through another stage which is called as work in progress or work in process, which is otherwise called as semi-finished goods. Then we reach the stage of finished goods. So the goods are ready for sale, which can be sold in the open market. When goods are sold for cash, we will be able to get cash immediately. On the other hand, when it is sold on credit basis, it will take some time to get the amount from sundry debtors. And again, the amount collected from sundry debtors is used to procure raw material, then to convert raw materials into work in progress and finished goods, and then it is ready for sale, then it is sold. So this process keeps on taking place. So now the time required to convert cash into raw material, the time required to procure raw material is called as raw material conversion period, and the time required to convert raw materials into work in progress is called as work in progress conversion period, and the time required to convert work in progress into finished goods is called as finished goods conversion period, and the time required to collect cash from sundry debtors after its sale is called as receivables conversion period. Next title is Importance of Having Adequate Amount of Working Capital. Any business enterprise needs working capital. It is referred to lifeblood for any business, without which it's very difficult to continue the business. In this connection, I would like to stress upon a fact that having inadequate amount of working capital and excessive working capital both are dangerous. So any enterprise should have adequate amount of working capital. Now let's see what are the benefits that could be derived from having adequate amount of working capital. To start with, solvency of the business. When we have adequate amount of working capital, it helps to maintain the solvency of the business by providing uninterrupted flow of production. When goods are produced without any interruption, we'll be able to produce and sell goods and we'll be able to get profit out of it. Number two, goodwill. When we have adequate amount of working capital, it helps to create and maintain goodwill because we'll be able to make a prompt payment, which in turn will create and maintain goodwill. Then number three is easy loans. When we have adequate amount of working capital, we'll be able to make a prompt payment, which will impress the suppliers. So they will not hesitate to supply goods on credit basis. Then the next advantage is cash discount. Obviously, when we have adequate amount of working capital, we'll be able to make bulk purchases. So we'll be able to get a discount also, both cash discount as well as trade discount. Next advantage is regular supply of raw materials. Of course, when we are making prompt payment, the suppliers will not hesitate to supply goods, so we'll be able to get a regular supply of raw materials. Next advantage is exploitation of favorable market conditions. So when we have adequate amount of working capital, we can exploit favorable market conditions such as purchasing its requirements in bulk when the prices are lower and by holding its inventories for higher prices. Next merit is ability to face crisis. So definitely we'll be able to face crisis without any difficulty since we have adequate amount of working capital. Next one is quick and regular return on investments. Any investor would be interested in getting quick and regular return on investments, which is very much possible with the help of adequate amount of working capital. Then the last benefit is high morale. Adequacy of working capital creates an environment of security, confidence, high morale, and creates overall efficiency in a business. So long we have seen how important it is for any concern to have adequate amount of working capital. Now we are going to discuss what are the various factors determining or influencing working capital. Number one is nature of the business. Public utility undertakings like electricity, water supply, railways, these undertakings provide services only for cash. So in that case, these undertakings would not require much amount of working capital. On the other hand, trading firms and manufacturing firms, they need to invest a huge amount in fixed assets and working capital, and also they have to sell goods on credit basis. In that case, obviously, they need more amount of working capital. Number two is size of the business. When the size of the business is quite large, it needs more amount of working capital. On the other hand, if it is small, it needs less amount of working capital. Number three is a production policy. For certain goods, we receive order only during certain occasions. If the production policy of the concern is to produce goods throughout the year and keep it ready for sale, in that case, it needs more amount of working capital. On the other hand, if the policy is to produce goods only when it receives order, in that case, it needs more working capital during a peak season and less amount of working capital during off season. Next one is a rate of stock turnover. Stock turnover is nothing but how often you are able to convert stock into sales. If the rate of stock turnover is quite high, you need less amount of working capital. On the other hand, if it is less, you need more amount of working capital. Next one is a credit policy. So if the credit policy of the concern is to buy goods on credit basis and sell its products on cash basis, it needs less amount of working capital. On the other hand, if its policy is to procure goods for cash and sell goods on credit basis, it needs more amount of working capital. Next one is a business cycle. Business cycle refers to alternate expansion and contraction in general business activity. In a period of boom, people will come forward to buy more products. So you have to produce more goods. You need more amount of working capital. And during depression, people will lack even the basic facility. They will not come forward to buy more products. So you need less amount of working capital during depression. Next one is manufacturing process or length of production cycle. So it's nothing but how long it takes to convert the raw material into finished goods. So if it takes more time, so in that case you need more amount of working capital. If it takes less time, you need less amount of working capital. Next one is seasonal variation. As I told you earlier, you will be receiving orders for certain products only during certain occasions. So if it is the policy to produce goods only during peak season or only when there is a demand for the product, so in that case, you need more amount of working capital during that particular season. During off season, you will not be requiring more amount of working capital. Next one is a working capital cycle. As we have discussed earlier, working capital cycle, we are starting from cash, with the help of cash, procuring raw material, converting it to finished goods, then selling the same to the customers, and again collecting cash. So if this working capital cycle takes too much of time, so in that case you need more amount of working capital. If it takes less time, you need less amount of working capital. Next one is a rate of growth in business. When the rate of growth in business is quite high, you need to explore more business opportunities. In that case, you need more amount of working capital. Rate of growth, when it is less, you will not require much amount of working capital. Next one is earning capacity. So when the earning capacity of the business is quite good, so in that case, you need to invest more amount and you have to try all possibilities to get more returns. On the other hand, if the earning capacity of the business is not quite good, it's not progressive, you don't need much amount of working capital. Similarly, dividend policy also influences working capital. If the dividend policy of the concern is to declare a dividend, even if you do not have sufficient amount of profit, so in that case, you need more amount of working capital. On the other hand, if the dividend policy is to declare a dividend only when you have profit, so in that case, you need less amount of working capital. Next one is price level changes. If there are much fluctuations in prices of materials and other, raw materials and other things which are required for a production, so in that case, you need more amount of working capital. If they are not if there are not much fluctuations, so in that case, you need less amount of working capital. I hope I was able to give some insights about working capital. Thanks for watching.